Welcome to Chai Pe Kharcha, where we have conversations on personal finance among four NRI professionals working at tech firms. Think of these like water cooler chats you have at the office. Only this time, you will have Ishan, Madhvesh, Rohit, and Siddharth as colleagues you will be listening into. Before we get started, a quick disclaimer. We are not financial experts. The content provided in this podcast is for informational and educational purposes only. Always consult with a qualified financial professional if you need financial advice. Right. Welcome back, everyone, to the new episode of Chai Pe Kharcha. This week, we'll be talking about investment in gold, FX, and real estate primarily. But if there are tangents produced through these three, we can go on to those as well. Also, we have a guest appearance on this show. Rohit is traveling, so he's not available, but we have Thomas, who is a Singapore resident and citizen. He is experienced much more than the three of us in the instruments I mentioned, gold, FX, and real estate. So his perspective would be extremely valuable to the conversation. Edom Thomas,
Hello.
I will start with Madhvesh this time, and then we'll slowly come on to Thomas's perspective. But Madhvesh, would you like to start on your investments in gold, FX, and real estate in terms of allocation? More importantly, why do you choose to buy these assets?
Sure. I bucket gold, real estate, and all other assets other than equity as in a separate bucket where I feel like the return from equity has high risk, but also high return. But in terms of these assets, the risk is a bit lower in comparison, but returns also will be lower. And in terms of real estate, my general philosophy is that and this is only bound to the India market because I'm not well versed with other markets in terms of real estate. I only buy real estate just for personal consumption. I don't see it as an investment vehicle, at least based on the current scenarios, where the rental yields or even like the price appreciation is not that much even if you take a 10, 15-year horizon. And the other biggest issue with real estate generally is that the liquidity, you cannot liquidify if you are in need of the capital immediately. In terms of gold, I think I see gold as a hedge against the broader investment markets, where if other things like the currency or even like equities go down, gold can give you a steady return over a period of years. So with gold, I don't look for a short-term horizon. It's more of a medium to long-term horizon, where I have some hedge or a kind of insurance in comparison to my equity investments. So based off that logic, gold, of course, is a very small percentage of my portfolio. I would put it somewhere around 5 to 7%. Yeah. And I also prefer to buy certain gold bonds because it gives some paltry interest as again to buying physical gold. But I also see the need of having physical gold if you have a goal towards it. So yeah, that's my overall.
Question on that, the physical gold piece. Why would you buy physical gold as opposed to gold bonds or gold ETFs? As
Yeah,
in,
I
what's
think
the advantage?
sure. So there are times where you would require to purchase gold ornaments. It could be for anyone in your family or even like for gifting. So what I do is like whenever I see that the gold price is going down, I try to buy like pure gold ornaments because like transporting bars are quite difficult. So if you have like pure gold ornaments, you can always exchange that for the gold ornaments that you are going to buy. So in let's say in future 5 years down the line, I want to give someone something in gold, and this is very prevalent in the Indian culture. So at that time, I did not pay money against the gold that I want to purchase, and I would just exchange the already purchased gold, and it also gives me appreciation in terms of price.
Or, yeah, that's an interesting approach. keep your wife happy as well and have an investment.
That's why I look
Good
for
strategy.
opportunities where you can buy gold, which is pure, like that not contain other charges like the making, etc., which again gives you a 1-2% cushion against the actual price.
Cool. Isha, do you want to go next? I know you have not invested much, but give us your perspective.
So I agree with Matvesh to the extent that these are good diversification and hedge instruments. I just have not had the opportunity to uh, either diversify or hedge. I also have a slightly different perspective on housing because I started my career in 2008. I think I've repeated this before to you guys as well. So a lot of my investment philosophy comes from what I've seen while growing up. In 2008, I joined a bank in the middle of a housing crisis. So the idea that housing is either an investment or will keep growing forever, that wasn't something I completely believed in. I don't think I believe it today either, because there are signs there might be another crisis on the horizon with housing. So it's I agree with Madhvesh on the point that housing is something you should definitely own because it takes one big expense off your plate if you can afford it. But I don't see it as an investment option personally. There may be other ways of investing in real estate outside of actually buying a house, which I haven't explored yet. And maybe I can hear about that. Gold is obviously something Indian families are heavily, heavily invested in. I believe as individual owners of gold, we are probably the largest market in the world. So we have a lot of gold in India. But I haven't personally yet purchased it. I do agree with Madhvesh. It could be a good hedge, just that I am not sure what the return would look like over a period of time. So that's something I have to still learn.
Before again, I am just delaying Thomas's grand entrance. Uh, Before he comes on, I'll quickly squeeze in my perspective, and then the stage would be completely for Thomas. I agree again. Yeah, it's a good hedge. Bitcoin is also a good hedge, which is why it's called digital gold. But we can go into that in a later episode. In terms of real estate, I don't totally agree with the idea that real estate can't be treated as investment. I know a lot of people who have invested in land and gotten tremendous returns. So it really depends on the area you're living in, the potential for for growth in that area, and some other factors that might determine if real estate is a good investment. In terms of effects, similar story to the other two. Nothing much to add. Cool. So we'll now move on to Thomas. Thomas, I will definitely ask the gold affects real estate question. But before that, could you give your general approach to investments?
Sure.
That's part one of the question. And part two, your current allocation in terms of assets across all the vehicles.
Sure. So I think general approach is I approach it in terms of allocation, right? 50 to 60% in anything that's income producing. So that could be REITs, that could be your fixed deposits, it could even be some way, right? It's giving you a recurring income. 10 to 20% in what I determine as value investing. So it could be equities, it could be commodities like gold. If it's at the right price, I'll buy it and I'll allocate with this 10 or 20%. The other 10 or 20% is in speculative trading. So that's where kind of the FX comes in. That's where also other strategies might come in that doesn't necessarily suit to be under something as income producing or value investing. This came from my time working in proprietary trading for some time. So the way that they are always doing things is more on the speculative trading side, right? But you cannot operate like that as a retail investor or within our own portfolio. Reason being is because the risk is too great. So the reason for the 50-60% in income producing is my take on the current economy and where it might hit in the future, where you'd like to diversify how you use your cash, right? And the reason why I say cash is because that is the most liquid form of where you can allocate things. It is FX, right? It's a form of exposure. So I think like Ishan mentioned, you prefer things to be in a certain currency because you're afraid that if it's in any other currency, it might depreciate against you. And then you actually sustain a loss when you try to convert against it. So if you don't allocate to anything, right, the natural form of an investment is just cash. And if you're holding cash, right, then you have other forces that work against you, like inflation, right? Or you could also consider opportunity costs, depending on how you want to look at it. So in a gist, it's trying to deploy cash as much as possible, but looking at what's ahead or what might be, where will you best position yourself as well as your portfolio so as to hedge against the risk or to grow where it's possible.
Got it. Ooh, so now to the topic of the podcast. What's your perspective on gold? And you can do it serially. Tell us your perspective on gold. FX you've already talked about a bit, and then about real estate.
Sure. So I think gold is a very interesting instrument, right? Culturally, each country has different usages of gold. So I think like 3 of the top usages of gold, it's not just like trading, but I know for Vietnam specifically, they can use it to buy houses. Gold being transacted in place of the Vietnam dong, that's also one. So I could see that also happening in other countries, right? So correct me if I'm wrong, right? Maybe India also has that, similar ones. Russia, big buyers of gold as well. How to make use of that information, right? Is that, to me, there is always a fair value in buying something. Although that value changes over time, right? Commodities are more, say, susceptible to demand and supply. So you can't value it the same way as you value an equity. But at that moment, right, are you overpaying or are you underpaying? And a way to check this is, if you really want to dive into it, is to see how much it actually gets produced. So per ounce of gold, right, if you want to calculate to that level, and the amount that's being sold on retail versus the amount that's being sold on electronic markets. If you wanted to speculate on it, right, you can view that, okay, I am actually buying at a fair price, but is there much prospect of it going further up instead of down, right? And that's determined on the rest of the market, which you can't really control. Then if you view gold as a commodity and you're trading it that way, it's more of a speculation. Then the way to view it is more of, well, a speculation rather than a hedge. And the reason why I say that is because there are other folks, right, different camps, which will use gold as more of a hedge, right? It's a hedge against inflation. They hold it more for long term, say maybe 5-10 years, maybe generations also, as a hedge against cash, as a hedge against inflation, as a hedge against, I don't know, society as we know it sometimes. And if you really go down the rabbit hole, that's where you also find people associating that with, say, digital currencies, right? You have your Bitcoin, you have Ethereum, digital gold, as you called it. So that way of doing things, it's not so much of a speculation, but your time frame and horizon of holding on to gold is really correlated to the nature of the trading that you're doing with that instrument.
And what do you think about FX?
So FX, as in a similar concept, you could use it for speculative trading. You could use it in the form of, say, your overall exposure of your portfolio. Let's talk about the first one first. So if you're doing it for speculative trading, you really need to trade in a large size in order for the FX difference to make sense, right? Some people do this through leverage trading. You have a bunch of trading platforms out there which is offering, say, 1 to 20 leverage, 1 to 100 leverage. So every unit move of that FX pair is going to give you more substantial return as compared to, say, like, okay, you're changing $100 today, and then 3 months later, you're changing that whatever currency you converted it to back into USD. And what you make is maybe, I don't know, $1 or $2. So that won't be enough to, say, grow your portfolio significantly, right? But if you did use leverage and you were able to speculate correctly, that would be one approach of using it to trade. About the second one, where FX is being used as a form of exposure, it's more of a risk and concentration approach, right? So let's say your overall portfolio, 30% of it is in USD, 30% of it is in your home currency, 30% of it is in another currency. And then suddenly an event happens where, say, one of those countries that's not USD, right, destabilizes. What will happen to that currency, right? For the rest of the market and the way that they react, what will likely happen is that that currency depreciates. So when your portfolio is positioned as such, that particular 30% that's exposed to that currency is going to get affected a lot. It's not just about the asset price depreciating, but after you've exited from that instrument and converted back to either your home currency or USD currency, you see that the gains are actually mitigated, or if not, like totally gone, if there were gains at all, right? So in these two approaches, the currency that you trade in also matters. It is more of like a long-term geopolitical risk kind of approach. But if you know that certain currencies are safer for you, you tend to opt for that. Personally, I wouldn't combine it together with the speculative trading aspect, but there are who like mega Excel sheets who actually do that, because if you're trading in size, right, leverage trading, of course, you're going to take the other side of the trade, which is the other currency as well. If there's a black swan event that happens, you're suddenly exposed to a currency that you didn't want to, but you were just hoping to speculate for a short period of time, say maybe a week or even a month. So that could affect your overall portfolio. So one has to be careful.
Have you made money in it?
That was in the trading company before, a little bit, I guess. Yeah.
While doing FX trading, you have?
I'd say we made
'Cause
more
I always wondered about it. But
I'd
go
say
on.
we made on the commodity side. Primarily, we specialize in commodities. The FX trading portion is more of a complement to that. So the reason being is because, yeah, you need something to back against the currency rather than speculating the currency itself. For a commodity shop, you always are naturally trading with other currencies, right? So where you are producing versus where you are exporting to or holding, and then where you are selling to. So there might be one or two exchanges of the currency where you need to have, and in between you can spot opportunities in order to take advantage of that. So trading as like a proprietary trading shop, right? It's very different from the speculative trading as an individual. The tools and the access to information is a bit different also.
What are like the safest ones and what are the risky?
Safest ones versus riskiest ones. Okay, I won't name any specific pairs, right? But you can check what the riskiest ones just based off their inflation rate. So if it's way too high, right, and you want to check that, is because let's say you do USD versus, I don't know, 2 or 3 years ago it was Turkey, right? And I can use Turkey because it already happened. If you were holding US dollars as a Turkish citizen, then you effectively hedge whatever else was happening in that country. However, if you weren't able to do that, right, then, and you wanted to exchange it for USD, you find out that it's been depreciated by so much. But as a speculator, right, as you're going to it, you're speculating on the USD to appreciate stronger than the Turkish currency. You would sell the Turkish lira, but you didn't know that inflation happened yet. But it became worthless overnight, right? It's like a few 1,000% inflation. That, in a sense, is a form of risk that it could have gone either way if, let's say, the Turkish version of central bank decided to do something else. So it's a different form of risk. But now that you know that it happened, right, the inflation rate in thousands of percentages, would you still hold the Turkish lira, right? There's also a counter kind of hypothesis whereby, hey, maybe they might recover, and there's a lot of gain that could happen because of it. Yeah. But as a exposure wise, as a holding thing, there's a few alternatives, right? Would you want to hold your currency in one that inflates over time for a long time? Right. So imagine every year there's inflation rate about 8%. Another one is 6% or 5%. So the longer you hold that currency at 8%, right, the more your portfolio is worth kind of less and less compared to another currency. I hope that makes sense.
Yeah, very interesting perspective.
Thomas, one question from my side. So the stuff you said about proprietary trading that you've done, obviously a lot of people who may listen to this wouldn't have that exposure, that experience, and they possibly also don't have the right tools to learn more about this stuff and understand what's happening in the market. So is there something you would recommend for people who haven't done this before or are starting out now and want to see what's happening in, say, the FX market, which markets are or what currency pairs are currently very volatile, and understand the reasons for it? And this is FX, same thing for any of the other instruments that you've currently invested in.
I think everyone has a different way to trade. Me, I'm more biased towards the geopolitical fundamental side of things. So for those as having the same notion, right, I'll actually recommend reading more of the news events. For example, right, more geopolitical. The recent news, I think Russia, Saudi Arabia, they're doing production cuts for oil, right? Why are they doing it specifically at this time, right? And what's the downstream impact to the currencies associated to oil trading? I think one can start that for the fundamental side of things. There would be roughly another camp, which is more, I would say, technical or non-fundamental. There are different ways to trade it, right? Technical indicators, robots, FX, automation, things like that. Learning to code is one, because this will significantly help you to both understand and trade the markets when you spot these kind of opportunities. So you could spot opportunities in the, let's say, programmatic sense, when you're coding things to detect, or something has happened, right? This indicator has turned bearish or something like that. And combine it with the rest of the signals that you as a trader understand on your own on why the markets move. That will help you to develop an edge. So over time, it's a development of these kind of edges, which allow you to have an advantage compared to others. And ultimately, when you build up enough of these, right, one can, well, profit, hopefully. And there's also kind of like a downside risk. So the less you understand about a market, right, the riskier it is. Because it's not just about exposing yourself to something and then like hoping things work out well. But there are other factors, which is the known unknowns. But as someone going into this, the known unknowns is something that you have not unpacked yet. That's risky in itself. Of course, every single trader doesn't know the unknown unknowns, right? That's definitely what everyone is going to face. But what you can help to de-risk your endeavor into this kind of projects is by trying to unpack the known unknowns.
Before we end, Thomas, quickly give your perspective on real estate too, given that Singapore is an extremely expensive real estate market.
So as to an investment and to buy it, right? So
Yes.
real in Singapore, I think it's like the name of the game. Here, everyone, I think worldwide also wants to get a piece of it because, well, a lot of the growth that's happening in Singapore, I wouldn't say it's tied to real business, and a lot of the investments that keep coming in is because of prices that appreciate, right? And I'm not talking about food prices or inflation. It could be things like the price of a building, it could be the price of the rentals, it could be the price of, say, investing in a company that is a cafe. All these kind of numbers have to go up in order to go and show growth. And for future investors to pump in their money into Singapore, they want to see numbers going up. And one of the best ways numbers are going up is through real estate or land prices, because that ultimately feeds into the rest of the things as well. So it's kind of bad for, I guess, everyone else that has to face the higher prices and all that. But it becomes investment instrument for investors and for speculators. But what might happen also if you see the risks and the downsides, right? What happened to China recently with China Evergrande and Country Garden? I'm not saying that could happen, but if one is too greedy, that could happen. Yeah. So the second part of it is that, okay, if you do think of it as an investment, right? How much can you allocate to it and can you service the payments? Because the rest of the investments you've talked so far is kind of you enter once or a few times, right? You can like dollar average it out, but you don't have to make monthly recurring payments in order to do it. So a property is a levered instrument, actually. Right? You're taking a loan, you're buying, someone's paying on it for your house, you're going to pay the bank and all that. The risk is associated to interest rates. The risk is also associated to the value of the property. It's in the interest of those owning existing properties for the price to keep going up. If it goes down, right, they're going to be in trouble with the banks. You also know that a few people are also speculating on not just one property, but multiple. Yeah. So there's some risk there that you want the prices to keep getting propped up. But ultimately, if something fundamental changes in the market, for example, the interest rates went too high, the companies, the developers are starting to default on their debt, like in China, then you get a cascading effect, which is very difficult to stop. So one might ask, okay, is it the right time to enter these kind of instruments? Personally, no. I think we're at a high point. If you had the cash and you have some buffer, sure, why not, right? But risks are increasing, right? It's very different from, say, 5, 10, 20 years ago, and when the prices were cheaper, when the interest rates were lower. Yeah, now it's kind of the inverse of that.
Got it. Cool. Thank you, Thomas, for coming on to the show. And thank you everyone for listening in.